Stop gambling with your retirement. Right now, somewhere between 40 and 60% of your portfolio is probably structured to fail, and you don't even know it. I'm going to show you exactly how to take $100,000 and transform it into permanent income, not hope, not speculation. Income that hits your bank account every single month, year after year, whether the market is up, down, or crashing around you. I've spent 40 years managing money, building companies, and studying what actually works. Kevin O'Leary, yes, Mr. Wonderful himself, has a specific 3-rule system for income generation. I've studied it, I've applied it, and I'm going to break it down for you right now. Here's the problem. Most people think a portfolio means buying a few stocks and hoping they go up. That's not investing. That's speculation dressed up in a suit. You've been sold a story that wealth means account balances. It doesn't. Wealth means income, cash flow, money that shows up whether you work or not. If that sounds different from what your financial advisor told you, good, because their version isn't working for you. Before we dive into the 3 rules that will change your financial future, hit that subscribe button right now. Join the thousands of others who are done with conventional wisdom and ready to build wealth the way the wealthy actually build it. Let's get started. Let me paint you a picture of what's probably happening inside your portfolio right now. You've got $100,000 saved. Maybe it's in a 401k. Maybe it's in an IRA. Maybe it's just sitting in a brokerage account collecting dust. And every quarter you log in, you look at the balance and you ask yourself, is this enough? Am I on track? Here's what most people believe. They believe that if their account balance goes up, they're getting richer. They believe that buying what's hot, tech stocks, crypto, whatever CNBC is screaming about this week, is the path to prosperity. They believe that growth and income are the same thing. Let me tell you the truth, and it's going to sting a little. You're confusing motion with progress. You're confusing a rising tide with swimming ability. And while you're watching that account balance bounce up and down like a yo-yo, inflation is quietly stealing your purchasing power at 4, 5, 6% a year. Let's quantify the damage. Take that $100,000. Let's say you've got it in a typical growth fund, maybe an S&P 500 index fund. Good choice, right? Not necessarily for income. Over the last 20 years, the S&P 500 has delivered average annual returns around 9 to 10%. Sounds great. But here's what they don't tell you. Those returns aren't linear. In 2008, you would have lost 37%. In 2022, another 19% drop. When you need to sell shares to pay bills during those downturns, you're locking in losses permanently. Now, run the numbers on what that actually cost you. If you had $100,000 in 2000 and you needed to withdraw 5% annually for income by 2010, after 2 massive crashes, you'd be looking at a balance closer to 60,000. The growth narrative cost you 40% of your principal. Kevin O'Leary puts it bluntly. A portfolio that doesn't generate income is just a collection of lottery tickets. Here's where the emotional damage hits. You feel trapped. You know you need to save for retirement, but every time the market drops, you panic. Every time it goes up, you wonder if you should have bought more. You're not investing, you're reacting. And reacting is expensive. The real villain here isn't the market. It's the conventional wisdom that says just buy and hold without a strategy for cash flow. It's the financial services industry that makes money when you trade, not when you succeed. It's the advisors who put you in growth funds because they're easier to sell than boring income producing assets. You've been sold a dream of future wealth while your present income dries up. And the worst part, the clock is ticking. Every year you stay in this cycle is another year of compounding working against you instead of for you. Let me ask you something. When was the last time your portfolio paid you enough to cover a month's groceries, a utility bill, anything at all? If you can't answer that question with a specific dollar amount, you don't have an income portfolio, you have a speculation account. So what's the solution? You need a system. You need rules. You need the framework that Kevin O'Leary has used for decades to turn capital into permanent growing income. I'm going to give you exactly 3 rules, not 20 steps you'll forget by next week. Not complicated strategies that require a finance degree. 3 rules, master these in that $100,000, whether you have it now or you're building toward it, becomes a permanent income machine. Rule number 1, the 8,020 income split. This is your foundation. This is how you sleep at night while your money works. Rule number 2, the dividend growth ladder. This is how your income grows faster than inflation without you lifting a finger. Rule number 3, the yield on cost mentality. This is the psychological shift that separates the wealthy from everyone else. These 3 rules work together. They're not optional extras. They're the difference between hoping your portfolio works and knowing it will. Now, before we dive into each rule in detail, here's what I need from you. Hit that like button if you're ready to stop guessing and start generating real income. This tells me you're serious about implementing these strategies, not just watching another video and forgetting about it by dinner. Comment below income now. If you're committed to making your money work for you, let me be clear about something. This isn't theory. This isn't some back-tested model that looks good on paper but fails in the real world. Kevin O'Leary runs his personal portfolio this way. I run my portfolio this way, and I'm about to show you exactly how it works. Here are the 3 rules that will transform your financial future. Rule number 1, the 8,020 income split. Here's the concept in plain language. You're going to take that $100,000 and divide it into 2 buckets. 80% goes into what Kevin calls sleep well at night investments. 20% goes into growth. That's it. Now, let me explain why this matters so much. The biggest enemy of permanent income isn't market volatility. It's you. It's your emotions. When the market drops 30% and you panic sell at the bottom, you've permanently destroyed your income stream. The 8,020 split protects you from yourself. Kevin O'Leary says it this way: I never want to be forced to sell anything ever. If I need income, I want it to show up in cash without touching principal. So how does this work with real numbers? Let's allocate that $100,000. The 80% bucket, $80,000 goes into high quality dividend paying stocks and fixed income. We're talking about companies with 20 plus years of consecutive dividend payments. Companies like Procter and Gamble, Johnson & Johnson, Coca-Cola, boring companies that make products people buy, whether the economy is booming or busting. Within this 80,000, you're going to build diversification across sectors. Consumer staples, healthcare, utilities, telecommunications, these aren't exciting, but they pay dividends, real cash, and they raise those dividends year after year. The remaining 20%, $20,000, goes into growth. This is your speculation money. This is where you can buy technology, stocks, emerging markets, even a small allocation to something riskier if you want. But here's the rule: you cannot touch this money for income ever. This is your inflation hedge, your upside potential, your maybe this goes to the moon money. Now, here's where people usually ask me, but Kevin says never to mix growth and income. Isn't that what we're doing? No, listen carefully. We're not mixing them in the same bucket. They're separate. The 80% is for income. The 20% is for growth. You never sell the 80% to buy more of the 20%. You never raid the income stream to chase returns. There's separate accounts in your mind and in your brokerage. Implementation steps: open a brokerage account if you don't have one. Transfer your $100,000. Then before you buy a single share, write down your allocation. 80,000 for income, 20,000 for growth. This commitment, written, signed, dated, is what keeps you disciplined when the market gets crazy. Common mistake to avoid: don't put the 20% into the same types of investments as the 80%. If your growth bucket is also full of dividend stocks, you've defeated the purpose. Let the growth bucket be volatile, let it ride. That's its job. Now, with that foundation in place, we need to talk about how to structure that 80% income bucket so it actually grows over time. That brings us to rule number 2. Rule number 2, the dividend growth ladder. Here's the core concept: you're not just buying dividend stocks, you're building a ladder of increasing income over time. Each rung represents a different yield and a different timeline, and together they create rising cash flow that beats inflation. Let me explain why this matters. If you just buy the highest yielding dividend stocks today, you might get 5, 6, 7% right now. Sounds great, but here's the problem. High yield today often means no growth tomorrow. Companies that pay 7 or 8% are often struggling, and they'll cut that dividend the first time earnings dip. Kevin O'Leary doesn't chase yield. He chases dividend growth. He says, I'd rather own a stock yielding 3% that raises its dividend 10% every year than a stock yielding 8% that never raises it at all. Why? Because 10 years from now, that 3% stock might be yielding 6 or 7% on your original cost. Let me show you how this works with numbers. Take that $80,000 income bucket. You're going to build a ladder with 3 rungs. Rung 1, Foundation Holdings. These are the ultra-safe, boring companies I mentioned. Procter and Gamble yields around 2.8%, 5%. Johnson & Johnson, similar. Coca-Cola around 3%. These companies have raised dividends for 50, 60 years consecutively. They're not going to cut ever. Allocate about $40,000 here, half your income bucket. Rung 2, growth payers. These are companies with slightly higher current yields, 3.5 to 4.5. 5% in aggressive dividend growth histories. Think industrial companies, financial select tech like Microsoft or Apple. They're raising dividends 8.1012% annually. Allocate about $24,000 here, 30% of the income bucket. Rung 3, high conviction specialists. These are companies and sectors you understand deeply, maybe energy, maybe real estate investment trusts, maybe telecom, higher current yield, 4 to 6%, but more volatility. You're getting paid more to tolerate the ups and downs. Allocate about $16,000 here, the remaining 20%. Now, here's the ladder effect. Every year, Rung 1 companies raise dividends 3 to 5%. RG2 raises 8 to 12%. Rung 3 might raise 5 to 7% or occasionally cut, which is why it's the smallest allocation. Over 10 years, your income from this ladder grows faster than inflation, faster than wages, faster than most people's savings rates, and you never sell a single share to get that income. Implementation steps. Research the dividend history of every company before you buy. The dividend aristocrats list, companies that have raised dividends for 25 plus years, is your friend here. Set up automatic dividend reinvestment while you're building the portfolio. But once you need income, switch those dividends to cash and have them deposited in your bank account. Common mistake, chasing the highest yield without checking the payout ratio. If a company pays out more than 80% of earnings as dividends, there's no room for growth or for error. One bad quarter and that dividend is gone. Now you've got the structure, you've got the ladder. But there's one more rule, the most important one that determines whether you actually succeed or just spin your wheels. Rule number 3, the yield on cost mentality. This is the psychological shift that separates the wealthy from the rest. Write this down. Yield on cost. It's the single most important concept in permanent income investing, and almost nobody understands it. Here's the definition. Yield on cost is the annual dividend you're receiving today, divided by what you originally paid for the stock, not what it's worth today, what you paid. Let me give you an example so you understand why this matters so much. Let's say you bought Procter & Gamble 10 years ago at $60 per share. At that time, the dividend was about $2 per share annually, around 3.3% yield on your purchase price. Today, Procter & Gamble trades around $150, and the dividend has grown to about $3.50 per share. If you look at current yield based on today's price, it's around 2.3%, nothing special. But your yield on cost, $3.50 divided by your original $60 is nearly 6%. You're earning 6% annually on your original investment. And that number keeps growing every year the company raises the dividend. This is how wealthy people think. They don't care what the stock is trading for today. They care about what the investment is paying them relative to what they put in. Kevin O'Leary drives this home. I don't look at stock prices. I look at dividend checks. The price is just the ticket to the show. The dividend is the show. Now, let's apply this to your $100,000 portfolio. You buy those foundation holdings at 2 and 12 to 3% yields. In year one, you're receiving maybe $2,500 to $3,000 in annual income. Nothing to retire on yet. But here's where the magic happens. Every year, those companies raise dividends. After 5 years, your yield on cost on those foundation holdings might be 4%. After 10 years, maybe 5%. After 20 years, some of those holdings could be yielding 8, 10, 12% on your original costs, while the companies themselves have barely moved in share price. And remember, you never sold. You never paid capital gains taxes. You never tried to time the market. You just collected growing checks. Let me quantify what this looks like over 20 years with that $100,000 portfolio. Year one income, approximately $3,000. Year 5 income, approximately $4,200. Year 10 income, approximately $6,500. Year 20 income, approximately $12,000 or more. That $12,000 is permanent income. It shows up whether you're working or retired, whether the market is up 30% or down 30%, and it's growing every single year. Here's what most people do wrong. They look at today's yield and think it's not enough. They sell boring dividend stocks to chase higher yields elsewhere, losing all that future growth. Or worse, they watch the stock price drop and panic sell, permanently destroying their yield on cost. The wealthy don't do that. They understand that yield on cost is the only number that matters for income implementation. Stop checking stock prices daily. Check your dividend deposits. Track your yield on cost for every position. Watch it grow over time. That's your scoreboard. Now, let me show you how to put all 3 rules together into a single actionable plan. Now, let's put this all together. You have $100,000. Here's exactly how you deploy it using Kevin O'Leary's 3 rules. Step 1, open your account and deposit the funds. If you're doing this inside a tax-advantaged account like an IRA, even better. Dividends grow tax deferred. Step 2, allocate $80,000 to the income bucket, $20,000 to the growth bucket. Write this down. Commit to it. Step 3, within the $80,000, build your dividend ladder. Take $40,000 and buy 5 to 8 foundation holdings. Equal weight them about 5 to 8,000 each. Look at the Dividend Kings companies with 50 plus years of increases. You want Coca-Cola, Procter & Gamble, Johnson & Johnson, Lowe's, McDonald's. Spread them across sectors. Take $24,000 and buy 4 to 6 growth pairs. Microsoft, Apple, United Health Group, Caterpillar. Companies with strong dividend growth histories but slightly higher current yields. Take the remaining $16,000 and buy 3 to 4 high conviction specialists. Maybe a real estate investment trust like Really Income that pays monthly. maybe a pipeline company like Enbridge with a 6% yield, maybe a telecom like Verizon. This is your higher income, higher risk trench. Step 4, set up dividend reinvestment for now. If you're still working, you don't need the income yet. Let it compound, buy more shares automatically. Step 5, take that 20,000 growth bucket and put it in a low-cost S&P 500 index fund or a NASDAQ ETF. Let it ride. Don't touch it. Check it once a year. Here's what this looks like in real numbers. Year 1, your income bucket generates about $3,000 in dividends reinvested. That buys more shares. Year 5, your yield on cost on the foundation holdings has increased. Maybe you're now receiving $4,000 annually from the income bucket alone. Plus, the growth bucket has appreciated maybe significantly. Year 10, you're receiving $6 to $7,000 and NUI from dividends. At this point, if you need income, you can stop reinvesting and have that money deposited to your bank account. This is not theoretical. This is exactly how Kevin O'Leary deploys capital. This is how I deploy capital. And this is how you transform $100,000 from a number on a screen into permanent, growing, reliable income. Here's the hard truth. Too many people watch videos like this, nod their heads, and do absolutely nothing. They'll tell themselves they need to research more. They need to wait for a better entry point. They need to talk to their advisor. Let me be direct with you. Every day you wait is another day your money is being destroyed by inflation. Every day you keep that $100,000 in cash or speculative growth stocks is another day you're losing purchasing power. Another day you're not building that yield on cost. Another day you're not moving toward permanent income. Kevin O'Leary says cash is trash, not because it's worthless, but because it's not working for you. Every dollar that isn't invested is a dollar that's actively losing value. You might be thinking, but what if the market crashes right after I buy? Good. You should hope it does, because if you're buying dividend-paying companies with strong balance sheets, a crash means you get to buy more shares at lower prices, locking in even higher yields on cost for the next 20 years. The people who will be wealthy 20 years from now aren't the ones who timed the market perfectly. They're the ones who started today, right now, while everyone else was waiting for the right moment. You have the rules. You have the framework. You have the specific allocation. The only thing standing between you and permanent income is your own action. Here's what I need from you right now. First, hit that like button if this video gave you a clear, actionable plan for your money. Not just entertainment L strategy you can use. The like button tells YouTube to show this to more people who need to hear it. Second, subscribe to this channel if you haven't already. Join over 6,000 others who are done with conventional financial advice and ready to build wealth the way the wealthy actually build it. Every week, I break down strategies like this, strategies that work in the real world, not just in textbooks. Third, leave me a comment. Tell me what's the first dividend stock you're going to buy. Put it in the comments. Commit publicly. I read these comments and I want to see your progress. Fourth, hit that notification bell so you never miss another video. The market doesn't wait, and neither should you. I believe in you. I believe you can do this. Not because it's easy, it's not, but because it's simple. Simple rules consistently applied over long periods of time. That's how wealth is built. That's how permanent income is created. You now have the same framework that Kevin O'Leary uses. You have the same 3 rules. The only difference between you and the wealthy is that they started. Today, you start. Join the community of people who are building permanent income the right way. No speculation, no gambling, just growing dividend checks that show up year after year. I'll see you in the next